All right. Good evening, everyone, and thank you so much for joining us tonight. My name is Rose Nkabinde from Financial Journey, and we're really thrilled and excited to have you here. As you can see on the call, we have Pilar Longwana and Lance Twala. But as we start, I'd like us to touch on a few things, just as housekeeping, just so that we know what to expect tonight. So, as you can see, the topic of the discussion tonight is about the two-part retirement system, and we'd like to simplify things as it is said on the screen. So, we actually expecting all sorts of people to join us on this webinar, and there could be people who are really familiar with the subject, but there also could be people who are not as familiar with the subject. The purpose is for us to share knowledge and to share knowledge across all those various kinds of people. So we will simplify what the two-pot retirement system is. We have experts with us tonight, and even if we talk about the technical bits, we'll try and really break them down so that anybody can understand what we'll be talking about. So we're going to have this as a discussion. As we've said on the invite, it's more like a panel discussion. I will lead that discussion by asking the questions. Our experts will then come in and give us expert opinions and answers and facts and tell us what we need to know. And we have switched off mics for everyone. However, the chat box is open. We also have the Q&A open. If you have any questions during the session, please feel free to post it on the chat box, and we will include it in the discussion. But also at the end of our discussion, we will open the mics for a Q&A session. So there we will take questions. Of course, you'll need to raise your hand, and then we will also give you an opportunity to ask questions. We are here for 2 hours. That is how long the session is scheduled for. And we will try and cover as much as possible. And our approach is that we would like to give a foundational knowledge of what we're talking about and then build it up to what the two-part system is, because we believe that the foundational knowledge is really the core of understanding what the two-part system is about. So we will take that approach, which is a step-by-step approach as we are leading up to the two-part system. It's the core of our discussion tonight, nevertheless. So that is how we are going to lead the discussion tonight. On the call, also, there are people who probably are familiar with Financial Journey and who we are, and there are those who might not be familiar with Financial Journey. So I'm just going to touch on who we are as Financial Journey. We are a financial wellness company. What does that mean? We work with various people to assist them with services that are giving them the skills and the empowerment to be able to make good financial decisions for their personal finance. So what that includes is services such as financial coaching. You get one-on-one sessions with financial coaches. We have services that relate to debt management that varies from what we call debt mediation, which is really someone who can get involved in between yourself and your credit provider for various reasons. They could be negotiating for your installments, or they maybe your installments need to be reduced, or they need to be increased, or there's a dispute between yourself and your credit provider, or you want to increase your credit score and you would like to work around your credit profile. And they can also clean it up, your credit profile. Sometimes you pay accounts and maybe they're settled and they're not reflected as settled on your credit report. Or maybe you have debts that should not show for whatever reason. Maybe they have prescribed or expired in layman's terms, and a debt mediator can assist you with such. We also have debt counseling. Some people want to get into debt counseling, some want to get out of debt counseling. Of course, all of those services are provided with an assessment, what we call a financial health assessment, which looks at your circumstances and also looks at the best solution that will suit your needs. We also have legal services that largely relate to rescission of financially related court orders, such as garnishee orders as well as administrative orders. And also we have a big part of our services that relate to helping people to get to achieve their financial goals, such as home ownership, vehicle ownership, or vehicle finance. We assist with those, and also saving, retirement, planning, as well as investment. We also cover those. Over and above all of those services, we provide knowledge in workshops and training to empower people to be able to make their own financial decisions. So that's what Financial Journey is. It provides all those services and empowers people in various forms in terms of services. So we're not selling any financial products, although we do partner with some financial services providers, so to speak. Where necessary, we'll bring those to the picture. We are now going to introduce, in fact, before we introduce our speakers, I just want to touch on one of the reasons why we put together this webinar. And it's because retirement saving is one of the areas that needs education. And we think that because of the greater need of education for us to understand retirement savings, we need workshops, we need webinars, we need educational initiatives such as this one. The statistics, and I'm going to share some of them, show that retirement saving is not at the right place when it comes to most South Africans. This is an article that I've just sort of quoted, which was posted by Moonstone, and it actually comes from a benchmark survey that was done by Sanlam last year, and it says 1 in 5 South Africans are able to retire comfortably. I think those stats have changed over the years. At some point, a few years back, it was saying 1 in 7 or something like that. So now it says 1 in 5 South Africans are able to retire comfortably. Their saving, culture of saving is not really at the right place in South Africa. But if you think about it, a lot of people, a lot of us, let me not say people, are finding it difficult to save. If you look at the third bullet, it says 40% said that if they were to opt out of the retirement fund, it would be because their financial needs are too large and they need money now. And I think we can relate to that. We've heard people around us, if it's not us ourselves, that have resigned just so they can access their retirement funds because they want to, they have a financial need they want to address. But in terms of investing or saving for retirement, a lot of people, like that 47% on the second bullet point, are lacking clarity about which product they should use in order to invest for retirement. So that's what we're trying to address largely. It's the education around retirement savings. So without further ado, let me introduce to you our guests, speakers, experts, and I'll introduce to you Lance Twala. I'm sure you can see him already on the camera there. And Lance has a really long career in financial services. As you can see there on the screen, he has more than 24 years of experience. His career started in the DTI, and he then transitioned into Liberty Life, where he did most of the financial services work there as a broker consultant until he was regional sales manager. And he also ventured into establishing a Liberty franchise. And I think it was one of the first Liberty franchises at the time. So he was a franchise principal with 12 staff members then. And he then expanded his horizons into being a consultant at Meneth Insurance, and that was in the USA. He then came back to the country, joined Nedbank, and then he also started his own Basebenzi employee benefits around 2012, and it was also within the financial services industry. And then he actually is one of the founding members of Financial Journey, and Financial Journey was founded in 2014. He's one of the founding directors at Financial Journey. However, he's stayed within the financial services industry by culminating, starting Abelang Group Capital Legacy franchise, and he is really committed into the space of the financial services that relate to investments and so forth. And I'm sure he can tell us more about himself as he starts to speak tonight. We also have Pila Dlungwana. Pila he comes from the Eastern Cape, and he then also started his world of finance quite a long time ago. He has a BCom degree from the University of KZN in marketing and economics, but he then took interest in the world of private investment, and he was one of the highly acclaimed private bankers. He worked at Investment Private Bank for quite some time and then transitioned into employee benefits, where he then spent about 19 years so far in that specialized field, where he still is. He's a principal consultant. He's been a principal consultant rather at Alexander Forbes over a number of years, and at the moment he is with Mufaro as one of the senior people in employment benefits. So he's got quite a long running career where he has dealt with the area of pension fund benefits as one of the benefits that he has been dealing with. So he is indeed one of the experts tonight. So I'll go back to this slide because we're not going to really have a presentation tonight. I did say at the beginning of our session that this is going to be really mostly a presentation, but where relevant, we're going to show some of the elements of our discussion over the screen. So let's get on to it. The core part of our tonight's discussion, retirement funds. And I'd like to really start broadly and welcome once more, gentlemen. Welcome, Lance. Welcome, Pila. And I'd like to start by asking a broad question around retirement funds. And let's start at the beginning. As I said, let's lay the foundation. Where do they come from? What was the point, and what's the purpose of having retirement funds? Can I start with you, Lance?
Absolutely, Rose. Thank you very much for the introduction. It certainly feels like I've been in the financial services for far too long. But believe it or not, I'm still learning quite a lot. Currently, I'm well vested in doing mergers and acquisitions, which is the space that I've managed to indulge into extensively. So I've got a very good, sort of like a profile around that area of expertise. And yeah, it's unbelievable. So many other things that I've touched on during my financial career and the journey that I've taken. But to, assist you in terms of answering the question that you've just asked now, it is very important for us to understand exactly, where does this actually come from. First of all, I want to assure you that the two-pot system was accelerated, sometimes in 2020, due to the parliamentary session that was obviously posed by the DA in respect of the COVID-19 issues. If you remember that, people were cash-strapped, some people were retrenched, some companies closed. COVID-19 really brought in a very terrible, sort of like environment economically for many South Africans. And the DA's understanding was that they posed a question to the government to say, let the government provide a mechanism for workers who would have contributed to some kind of a retirement product, to have access or once of access to their monies. But I want to also mention that the whole two-pot system is not a new phenomenon as such. Our government back in 2012 did have a sort of like a program that was initiated then. And that started with the research where it found that although a lot of South Africans or many South Africans contributed towards a retirement fund, but only 10% can maintain the same lifestyle after retirement. And that is obviously concerning. And the reason being is that most members tend to withdraw from their retirement savings before retirement. And I would remember that when at some point the teachers or generally, teachers, when they had that, or most government employees, when they had that, there would be changes or reforms as far as the profit and fund space or retirement space, where they cannot access their monies until the retirement. There was a wave of people resigning, from their jobs, and that was quite dangerous because then people would access their funds and only to find that they now have to belong to, they have to rely on the government, for at their retirement stage, to survive, and that was not going to actually work out fine. So there has been a lot of obviously ups and downs as far as the issue of the retirement space. But what is very important is that we need to understand where we are now, and that is very key in a sense that we need to say why has the introduction of the two-pot system came into effect and came into place, not effect, but came into place. And let's understand what are the intentions of the two-pot system. The intention essentially of the two-pot legislation is to essentially enforce a level of retirement savings preserving your retirement savings, and thereby ensuring that the retirement savings are retained for the purpose of retirement, not for individuals to go and consume, their savings, even when someone leaves their employer. And that was the very important part of this proposed, legislation. So this really intervention, it's welcomed, it's good, and it's desperately needed because, as I've indicated before, that when people would leave their employment, they'll just take their monies, and then you can't get a job. Then what happens? Then you rely on the government, provided that you've reached the prescribed age of you receiving what we call a grant. So with only a small portion of people in South Africa who are preserving their funds, as I've mentioned, only 10%, it meant that your replacement ratio in the retirement space would, far shortfall of the 75%. In other words, you are required at least to have 75 to 80% of your pre-retirement income replaced after retirement. But of course, this would mean that that would not be the case. But the second part, as far as the two-pot regime endeavors to address, is obviously also to recognize that in many households, there is a requirement for occasional access to savings to cater for certain emergencies and unforeseen circumstances. And they had to take that into consideration to say, how do we then create an environment where people can be able to access their savings, but whilst being able to maintain their savings for retirement. So the sad reality is that currently, as we speak, many people resign from employment to access their pension benefit, and this is the only source of savings. So this increases their future financial risk, as they will most likely experience financial hardship and will now also be unemployed. Now, typically, what is it? What is that we're trying to do? The government is trying to sort of like balance, two opposing forces: one of long-term retirement savings, and with short-term financial distress. So you want to make sure that those two are handled quite well, and that is really the outcome that we were here now, where there is a retirement or two-pot system that is going to be introduced, and that is going to be effective on the 1st of September. And hopefully that in a manner somehow optimizes the outcome of the retirement fund members. And lastly, as I conclude, sorry.
Yes. No, go ahead. Go ahead.
Yeah, so this two-pot system, it will really, be creating 3 pots, which is your best debt pot, which caters for retirement phase, retirement savings accumulated prior to the implementation date of the retirement contributions, your savings pot, which members can access prior to retirement, and the retirement pot, which must be preserved until retirement and cannot be accessed as a cash withdrawal at all or before the retirement age. So that is really the reason why we find ourselves in the new coming regime of the two-pot system. I hope I've provided enough background as far as that question is concerned. Thank you.
All right. Thank you. Thank you so much. It's a really nice summary of what the two-pot system is. And as we said, we'd like to break it down a little bit so that we sort of have some level of detail so that we understand what you've just laid on the table, Lance. So that is why I would like us to maybe take a step back and say, what was the Pension Fund Act about as a starting point? What is this? We know, for instance, that there's contributions that are made in an employment setting where there's an employee benefit called a pension fund. And that we have heard of pension funds as well as provident funds, and what is the setup there, so that when we then lay the foundation that talks about the two-pot, it makes sense and we know what is affected and what has changed. So let's start with the current, and then we can talk in more detail about, and we will just touch on the brushstrokes so that those areas are understood by everyone on the call. As I said, we kind of assume everyone technically understands what pension fund is all about. Pilar, can you come in and give us a little bit of that background?
Yeah, thank you, Rose, and good evening to you, Lance and Rose, and also to everyone on the call. Thank you for the kind introduction, Rose, and thank you, Lance, for your very nice outlay of the whole session. I think, yeah, you put everything together there for us to work on. Rose, in terms of just going back, I mean, I'm cognizant of the fact that you're saying that we've got a varying audience. We do have people that are not really exposed to our industry, and we might also be having people that are very exposed to the industry and are experts themselves. So one tries to accommodate everyone in what we're trying to present here. The issue of pensions, the issue of pensions go back many years, but I just want to give a breakdown of what we have in South Africa. In South Africa, we have a pension fund, which is briefly is where you are able to get only 1/3 of your outcome, and only 2/3 will be kept behind as a for you to buy an annuity, which you get a monthly pension from. That's the basics of a pension fund. And you will see later, in fact, that that's what the government was trying to do with two-pot. They were trying to go back to pensions for everyone, and we'll clarify that why we're saying that. And then there's a provident fund. Provident funds came around the 1980s when unions felt that at the time that the pension funds were not working for them. This issue of keeping 2/3 behind and taking only 1/3, mostly blue-collar workers being low earners, their pension was too small on a monthly basis, and that 1/3 was too little to use for anything anyway. So they rejected that and wanted to start their own provident funds, which you can take the whole lump sum the whole amount as a lump sum. And then we have annuity funds, which are retirement annuity funds, which are now, those are for self-employed people that are not linked to any employer. They make their own contributions into this fund, and it's actually a pension fund for those that are self-employed, because you only can get the 1/3 there as a lump sum, and you must buy an annuity with the 2/3. And the last one is a preservation fund. This is now allows those employees that are responsible, who, when they leave their current employer, they still want to continue preserving, and then they go into a preservation fund. They don't take anything, and that money stays on until the minimum 55 or more in the preservation fund. But if they want to have a withdrawal, they can take one amount, which is once off. It could be the whole amount, or it could be a percentage of that amount. And that's basically where we are. The government was faced with all those, and they wanted to harmonize them. That's the word they use. And the harmonization started long time ago. I mean, Lance is correct to say around about 2012, the government was talking about a dream to have everyone having access ultimately to some kind of retirement savings. So then they were cognizant of the fact that we've got pension funds, and then those people cannot get all their money. We've got provident funds, those people can get their money. We've got retirement annuity funds for self-employed. We've got preservation funds for those that are moving between jobs. And they wanted to have something almost one that will work for everyone. And it is true that around 2016, the government tried the harmonization thing. Around 2016, they wanted the pension funds and provident funds to be the same. And there was a lot of talk about T-Day. There was a lot of talk about annuitization, which also referred to harmonization. That is when what Lance is referring to happened, where employees were in provident funds, just in pension funds, or just in savings for retirement schemes, felt that the government might be trying to access their monies, and they tried to take their money and go. They didn't understand it, and that was reversed. It was reversed for them to go and think about it again as to how can we best do this, so that people understand it, that we're not taking your money, or your money is not going to be inaccessible forever. Then they went into annuitization. We're now in 2021. What is called annuitization. At that time, they said, okay, we really want to do this harmonization. So how we're going to do it now is that we're going to leave you with your provident fund as it was. From the 1st of March going back, let's say 28th of February 2021, going back, that money that you saved as a provident fund member, you'll keep it. That's our peace with you, not to touch your stuff. We'll keep it. But as a government, we do want to instill or have some retirement reform going forward, because we do believe that preservation in the country is important. So as part of a compromise, we will leave you with your vested benefits that you had before. But from the 1st of March 2021, we will now start a pension fund scheme. I'll call it that, because that's what it is, for provident fund members, meaning that now you will now no longer be able to have full access to your money at retirement, given some limits, which I will talk about. You will now, from the 1st of March 2021, at the end, when you retire, you'll get 1/3 as a cash lump sum, and the 2/3 you must use to buy an annuity for a pension into whatever. And then there were limits about if the whole amount is less than 247,500, then you can take all of it. But if it's more, the 2/3, 1/3 will apply. So that was, I won't say agreed, but it was implemented. That we have it as we speak. So there were kind of pots there. There's vested portion that you had from the 28th of February going back, and anything after that, you were now working under a new system. And yeah, I don't know, Rose. I'll probably just stop there. Maybe you want to come in there. Thank you.
Yes. Okay. So let me just summarize if I heard you very well. You're saying currently, or in the current pension fund regime or system. And I'm saying that loosely. because I want us to have a clear picture of the before and the after. So the before picture, where employees would contribute into a pension fund or a provident fund. And they would not be able to access that money. And I'm saying that loosely because my next question is about access. They would not generally be able to access that money. However, there were a few exclusions. But at retirement, they would access a portion in cash, and that portion was 1/3. And the 2/3, they will have to buy a product which will allow them to earn a little installment every month. And that is what an annuity product is. And that is their pension.
Mm.
However, that is pension funds. Provident fund, one would be able to access all their money at retirement. Yes, we will talk about exclusions, but generally speaking, at retirement, they'll be able to access all their money. And there's no breakdown in terms of what happens. You just get all your money until the timeline you were talking about. And we'll get back to it, where there were changes or amendments that said, no, the Provident Fund rules will change and they will now be similar to the pension fund in that the 1/3, 2/3 rule will apply. That's what you meant, 1/3, 2/3 rule. However, I'm now talking about pension funds as well as provident funds. Then there's what's called a retirement annuity, which you touched on, and you were saying that is a product that is designed for someone who's not an employee, somewhere who's getting an employment benefit in a form or shape of retirement savings or pension fund or retirement, or rather a provident fund. But it's when an individual on their own accord voluntarily buys a product that resembles a pension fund. And it also has the 1/3, 2/3 rule that applies to it. Now, my next questions now, I'm not sure whether Lance is still on the call. I don't see him on the camera, but I'm sure he's there. So my next question, and while we are still talking about pension funds, current picture, the before picture, let's just touch on access. You've mentioned access at retirement, but there are exclusions there. Can we talk about them a little bit? I don't know who wants to come in. And you've mentioned access where people resigned, I think, and they would take their monies. Can you unpack that a little bit?
Yeah, I'm actually happy to go into that, just to finish the line I started. And also just to add that, retirement annuities, while they are basically mainly for self-employed people or people that are not in occupational employment, it also is used by individuals who are employed as additional, savings for themselves. You can have as many retirement annuities as you want from a diversifying point of view, but it's also allowed for members to have that benefit in terms of benefiting from tax deductions. Because the tax now, in terms of harmonization, all the contributions you make now as an individual towards retirement, they get similar tax deduction. It's one formula for everybody. It's a 27.5% of your contributions, up to about 350,000 per annum for everyone. So it doesn't matter where you're contributing. In terms of where the flexibility is in terms of accessing, because the issue of accessing, really, one thinks that maybe it should have been discovered long time ago, that had you given people some kind of access, maybe wouldn't have people raiding their retirement funds so much. Because people really, we still have questions now with people. When you talk to members, they say, why cannot I not have money to educate my children? How can my children drop out of university when I've got 500,000 sitting for my retirement? And as a parent, the first person you think about is your child more than yourself. You don't care about that retirement lump sum if your children cannot go to school. And that has not been changed. And it's still in effect. Maybe some of these, things that are being done now are towards assisting that. So the access that you had, that you still have, Rose, because we're not at two-pot yet, that we still have are that you resign, you get all your money in the old system, in the provident fund, the vested and non-vested portions that we mentioned, you can still get all of that. Pension fund, if you, whether there's 1/3 or 2/3, that it applies at retirement. Right now, you can still get it as soon as you resign. In your preservation fund, you will have to wait for 55 if you've taken anything in between. Otherwise, you can come in and take something. But in a retirement annuity, you either wait for 55 or you must be permanently disabled, or death, which applies obviously to all of the others as well. So that is the current access right now. So if I need to have access to my money now, I need to get out somehow. Or if I need to, there's Section 19.5 of the Pension Funds Act now, which allows access via your pension-backed home loan, which means getting a loan from the fund using your fund credit as security. And those loans normally come at a very reasonable rates, because your pension fund credit is actually guaranteed in there. It can be taken by anyone, and no law is allowed to attach your money that is in the pension fund. So that is what you can have, which is to renovate your house, to build a house for your relatives, your dependents, and people that really rely on you, basically, for you to look after. So there isn't much in terms of access except for that. Hence, where we are now.
Okay. So I will always summarize when you finish, because I think when you flow, I'm always trying to reach out to those who might have missed something. So in summary, you were saying there's mainly about 4 exclusions in terms of access. So those exclusions apply before retirement, most likely, which is resignation at work. Once you resign, you can get your money from your pension fund, pension provident fund. Retrenchment is also one of the things you mentioned. Permanent disability, death. Those are the main exclusions. And then you also mentioned that there is a access in a form of security, or we can call it collateral, that your pension fund or your fund credit can be used as security for a home related, I'll call it home building, home renovation, as long as it's housing related product, which is called pension-backed loan. So it is backed by pension because it's secured by pension. And that does not take money from your pension fund, but it uses the fund credit as security. So that's how pension funds can be accessed in the current system.
Yes.
In
I
summary.
would like to add in something there.
Please go ahead.
Yeah, thank you very much, Rose. And Pila, you've actually provided a very good context around it. But one important point in that is that as far as the pension-backed loan, whilst it doesn't take any monies from your pension as such, but you're using your money as collateral, remember that in instances whereby your employment is terminated, the Act does allow for the creditor, if you did have that loan, to actually go and attach whatever that is owed in as far as that pension-backed loan is concerned. And that's another way that in which that money would be then, be taken from you. So I thought, let me just add that as part of the overall accessibility of the monies. Thank you.
I think one day we should have a webinar about pension backload on its own. It can be a 2-hour topic. Thanks, Lance, for adding that. You've touched on the preservation fund, Pila, and I don't think we did talk about what it is. Can we quickly just describe what the preservation fund is? Because you've talked about it in terms of access, but we didn't give a proper introduction of what preservation fund means. However, my next question, after you've given us that background of preservation fund, is tax. And in the current regime, obviously, the before picture, once we're done with tax and we've described what happens the tax-related part of the current system, we'll then move on to talk about the 2-part system. Pila, do you want to come in? Your mic, okay. Yes, thanks.
Okay, thank you very much. The preservation fund. So preservation funds are the funds, I mean, it's English, preservation. So for me to understand it is I just think about that. Preservation is saving. So you've been employed fully, properly, and then now you're probably wanting to change employment, but you don't want to spend your money because you can see that you are close to the end. So you want to keep it somewhere. So you go into a preservation fund. There's a preservation provident and there's a preservation pension. So you can choose which one. If you're coming from Provident, you're likely to choose the Provident Preservation Fund. Coming from pension, choose the pension one. So in there, when your money is transitioning across, you can take immediately a portion of that money, but you will never have access to it again before you reach the age of 55, or maybe you're permanently disabled or you can't work. Actually, I think the preservation fund doesn't even allow the permanent disability. That's their retirement annuity. Preservation fund, it's 55 years. So you will have to do with maybe an insurance that you took on the side. But once you are in, also, if you've not taken anything, you can then take that portion that you want. So there's no limit. You can take from 0 to 100% or 0 to 50% or 30%, any limit you can take. So that's the preservation part of it. And then in terms of taxation,
Can I just sorry, Pilar, before we get to tax, I feel like let me summarize the preservation first, and then when we get to tax, we'll then deal with tax. I want to put it in layman's terms. Okay, because you're an expert, you tend to go to the technical English. So
yes,
let's unpack preservation a little bit, and Lance, you can come in at any point as well. What you're saying in summary is that if I, as an employee, decide to resign, and now I'm at a point where I have to make choices, or in terms of my pension fund, I'm given options. And one of those options will be preservation. And I don't want to mess this up. Lance, are you able to maybe put it in layman's terms?
Absolutely, Rose. You will understand that in my work working with the labor, if I were to ask a Pilar to come and explain some of these very complex concepts, sometimes even myself I tend to get lost because he's quite a genius when it comes to these things. But let's go back to the understanding of a preservation. And what does actually the name preserve mean? When you're preserving something, is to putting it away in a safe place, similarly to saving it, but you're preserving it for future use. That's what it actually is. And within that preservation, you want to make sure that, firstly, when either you leave an employment and you join another company and you've decided that the funds that you have saved as in that previous company, you can preserve those funds. So that's what it means in essence. But what is very important is that when you look at the preservation fund, you need to have obviously an informed decision in terms of where you're preserving that money, what will be required, what is your desired outcome in terms of yield. In other words, how would you like that money to actually grow? And there are various companies that provide that platform for one to actually preserve their benefits. And what is it that you can do during the preservation, as once you've bought that particular product. So it's very important that you understand that, as part of proper, retirement planning, process, you need to make sure that you understand, how you can use the preservation funds, to your benefit. So in essence, if in a layman's term, if one would say, what is the, preservation of funds, it would essentially mean that you want to make sure that you keep your funds safe and you want them to still grow, give you, a maximum yield, and with the view that, these funds that you've actually preserved would help you towards your retirement plan. I hope that actually provides the context or the simplified meaning of a preservation fund.
Okay, yes, thank you so much. So if I resign as an employee, I'm giving an option. It's either I withdraw from the fund, and as you have said, Lance, as I withdraw, I can still find an investment product to put my money in if I still want to save for retirement. But also I'm given an option to transfer the pension fund either to the new employer if I am employed elsewhere, or to an RA, a retirement annuity. Then also I'm given an option to preserve those funds. So I can preserve them in a preservation product, which is what we were unpacking now. And it essentially means those funds will stay in that fund, in that product until retirement. So I'm not going to touch them. I don't want to touch them. I still want them to grow until so that I can access them at retirement. Okay, I see you're nodding. If the experts are nodding, it means we've covered that sufficiently. Let's talk tax. On the before picture, as I said, we're still talking about the current pension fund system. And then as soon as we're done with tax, we get straight into the two-pot system. What's
Just
happening?
before you
Okay.
go into the tax regime,
Yes.
Rose, it must be understood that the benefits of going for a preservation fund is that when that transfer happens, there's no tax implications as such.
Yes.
And that is a very, very big benefit, unlike when you then decide to take some of a full amount of whatever you're saving, your fund credit or your savings, they will be taxed, they will be subjected to tax. So the nice thing, and which is great, and people need to understand that when you then moved from that old employer to the new employer, and then you take you buy a preservation fund, you are not taxed, and that's very, very important to know. So just before you move to the tax regime.
And it's a good thing that you touched on that, Lance, because there's a question in the chat box about does all this have any risk of or negative impact? So when funds are accessed in terms of withdrawal, in a case of resignation, there's a tax implication. And I think we're going to touch on it as we're talking tax. However, as Lance, you have said, if there's a transfer, whether to a preservation fund, RA, or another pension fund, if I move to the next employer, just confirming, there are no tax implications, correct?
Absolutely, Rose.
All right. So let's then talk about tax, and we're going to touch on the tax implications on withdrawal. But I want us to then lay a good foundation until we get there. Pilar, do you want to come in? Your mic is on mute, Pilar.
Yeah, I stay muted.
Yes.
Yeah, the tax, at least we have not received any changes from a tax point of view, so we can be confident that the existing tax tables still apply to even into the future, at least until the next financial year end or next budget speech. There's a lot of penalties that you get for withdrawing. As we're saying, government is trying to encourage preservation, saving for retirement, so that there is less pensioners that the government should be looking after, so that there's less SASSA recipients. So because when you're contributing for everything, you're contributing for, and in terms of retirement, the government gives you tax deductions, meaning they're giving you some kind of allowance. Thank you for assisting us as the government. But when you take it, they take it personal, and they tax you badly. I will talk about tax on withdrawal. And that is why the means test in South Africa still applies. This is the system where the government checks when you retire whether you should get some of that SASSA or not. So they ask you, how much are your retirement annuities here? How much are your children giving you on a monthly basis and all that? When it gets to a certain amount, they reduce the SASSA grant, or you get nothing because it's what you are getting is enough. So that money is they make sure that when we leave our employment, they take a portion of that to preserve for later. So if you leave, Rose, I mean, I'm speaking now, and I'm speaking openly in terms of I'm not looking at any table in front of me. But for a withdrawal, that's the most taxed part. Withdrawal will be your resignation, your dismissal, where you will be taxed only the first 27,500 will be tax free. and it goes according to a table. And I think we might have a table maybe later on just to show everybody how it works. The first 27,500 is the only amount that's not taxed. So if you can work it out yourself, if you have 500,000, only 27,500 of that will be tax-free. The rest will be taxed according to a table. You could come out bleeding there quite a bit. But if you were to wait for it and then wait for your retirement age in terms of the rules of your own fund, then you would have the first 550,000 tax-free. And I've just said now that I've made an example of 500,000. If you had that amount at retirement, that would mean your 500,000 will be tax-free, provided that during your working life, you've not taken you've not made any withdrawals that are part of that, because it's a lifetime for everybody. So you can see the benefit already that if you wait for retirement, you can actually get quite a nice sizable tax benefit. That applies to if you become permanently disabled, that table for 550. If you become retrenched, and when you reach your normal retirement. So those are the two tables that apply. Thank you.
Okay, thanks, Phila, and I will then give a summary there just to confirm if it's really understood. So if I heard you correctly, there are two tax tables in application here, right? There's a tax table which is really unkind from what you've said, which then relates to early withdrawal. And early withdrawal is penalized because the government is trying to encourage us to save for retirement. So now you're not saving for retirement. So they are now penalizing you with tax if you were to withdraw before retirement. And that applies to resignations and dismissals, if I heard you correctly. And the first 27,500 is not taxed. Anything above that is taxed heavily if you withdraw before retirement. However, if you are before retirement accessing the funds due to retrenchment, due to permanent disability, if I heard correctly, I'm not sure if I'm missing anything else, then the retirement tax table, which is a different table, will apply. So on that table, which then applies to retirement, retrenchments, permanent disability, the first 550,000 is not taxed. That's what you mean when you say tax-free. Anything beyond that, it is taxed, but it's a different tax table. It's not trying to penalize you, but it's trying to get you to contribute to tax. And that I think summarizes what you said. And let's talk a little bit about a retirement annuity. You mentioned earlier on something about tax and rebates, I think, about retirement annuity. Lance, are you able to come into that question, to answer that question?
Yeah, so I just want to go back and highlight something quite important as we're obviously, talking about this tax regime. And probably that will help, provide the answer that you're looking for. So Pila is correct. I mean, the first 27,500 is tax-free, and at retirement up to 550,000, that is also tax-free at retirement. But it's very important to understand what kind of tax are we talking about here in terms of the rate and percentages. So any amount that is, taken with over and above the amounts that are exempt, you should be looking at paying tax of about between 18 and 36%. And of course, depending on how much you have taken and depending on your tax marginal rate. So that is very important for people to actually understand that, if you were to take that money, you're looking at a very high, tax rate that you're actually paying. And it's understandable that people want that money because they've got all sorts of reasons and problems and so forth. But if you look into it from a logical perspective, it's quite a huge, sort of like penalty that you're actually paying. Now, I want to find, just to clarify the following. As far as, your effective tax rate is actually concerned, That is all dependent on the amount of money that you actually earn. And in this particular instance, either you can look at your annual tax table, or you can contact your financial advisor to provide you with the understanding as to what would be your effective tax rate. And if you've got plans, to resign and use up some of your pension or savings, it's very important for you to actually look at that. I'm not too sure if that actually answers your question, Rose, or do you want me to expand?
Yes, it does. Thank you so much. And I'm seeing some questions on the chat box that relate to tax. One of the questions is saying, when I take an early pension at 55 with the government, what is tax free? Is it 27,500 or is it 550,000? Pila, do you want to come in?
Yes. Thank you. Yeah. So the tax, when you say retirement tax rate, that tax rate refers to the tax as in the rules of your pension or provident fund. When is your retirement tax date in your retirement fund? Early retirement is also regarded as retirement, and early retirement in terms of the Income Tax Act starts at 55, age 55. So that's why in most cases you do see this age of 55. It's allowed in terms of the Income Tax Act, but most funds will not put it as a retirement age. The retirement age will be something like 60, 62, 3, whatever, but will allow in the rules an age of 55 as early retirement. And SARS recognizes that as retirement and will be taxed according to the retirement tax rates. So if you are working, whether it's government or anyone, if your rules refer to early retirement as 55, you will be taxed favorably in terms of the retirement tax tables.
Okay. And then another question quickly, because I think at least in about 5 minutes, I'd like us to get straight to the two-pot system, which is why we're here. Another question is, as a member of a fund, do I get 27,500 for withdrawal and a further 550,000 when I retire? Or will the maximum be 550,000?
Okay, so safely you can say the maximum is 550. The fact that you've been resigning, you are actually taking from that maximum 550. So it will be recognized that you've been taking money throughout. And then the SARS is keeping a record. That's why there are forms that maybe you might know better, the IT 80 something or whatever. Those forms, they are keeping a record of what you've been doing. At the end, in that 550, if you've already taken a benefit of, like, say, 200,000 in tax, the 200 will be taken that you've already benefited 200. Then you'll only get 350 tax-free. So it's not just if you take in between and then now you retire with 1 million, you think you're going to get your 550 tax-free. No, it will count that you've been taking throughout. Taxman doesn't forget. You must remember that.
I love that. The taxman does not forget. Okay. So I'd like to wrap up that at that point. I think we've covered quite a bit. I think pension funds on their own, they could maybe take a 2-hour conversation on their own. So, but I want to just pay homage to the fact that we're talking two-part today, and I'd like us to move on to that. I think we've covered quite a nice, we've laid quite a nice foundation when it comes to what we will refer back to as we are talking about the two-part system. So let's get on to it. And I think at the beginning, Lance, you gave us a really good summary of what it is. And, also there are people on the call that joined quite late. Maybe we can touch on that background a little bit again. And I'm going to share my screen, I think, because I'd like us to just have an idea of that background and what it looks like, even though it was touched on a little bit earlier on in our conversation. So because I went to the slide at the beginning, that's why I have to scroll back. So yes, let's talk about this timeline. I think Lance touched on it, but take us through it, perhaps, Pila. Where did this two-part story start and what's it about?
Yeah, I think Thank you very much, Rose. I think you've got a very nice timeline there. It breaks things into what, 3 segments or so. At the top, you have up to 28 February 21, retirement and withdrawal. You used to get, or you would get 100% cash of your money. So this is now the annuitization I was talking about. Up to the 28th of February 2021, anything that you had before that as a Provident Fund member, you could get all of it as cash. And you can still get it even now, because that's what became to be called vested benefits, or vested portion of your benefits. And then from
Pilar,
the first,
if I can come in, sorry, Pilar, is that referring to the T-Day now, up to that 28 February 2021, correct?
yes,
Is that the T-Day?
That's correct. That's correct. So then on the first, then it was agreed that on the 1st of March, going forward, you will now be introduced into a pension fund kind of a system, which means the rules of a pension fund will apply. If you simplify it, that's what it meant. Because now they said, from that going forward, you're going to have now to get only 1/3 at retirement as cash, and 2/3 you will get it as you must buy a pension, which means you must buy an annuity. So that portion was called non-vested, because it's a new beginning for going forward. The previous one, it's called vested. That you can get even now, you can get all of it cash. But then there was a rule that was put in place that if that vested portion, that 1/3 plus the 2/3, if that together is less than 247,500, if that amount, all of it, the non-vested 1/3 and the 2/3 non-vested, if both of them at retirement are less than 247,500, you will then be able to get all of that in cash. But if it's more, doesn't matter how much more, you will break it down to 2/3 and 1/3. Then you will receive that as a pension after you've received your 1/3 upfront as cash. So the idea of I mean, Lance mentioned the issue of how it started with the DA in Parliament and stuff like that. So the idea of two-pot started around there, where even though it was not called two-pot, it was just said vested benefits and non-vested and retirement benefits. It started there, that now you have these two be restrictions were not as much, because the restrictions for retrenchment that we have now were not there at that time. And I don't want to be ahead of myself, Rose. I think I was just talking to this table. I mean, to this in front of me.
Okay. So, all right. So it seems like it started way before most of us thought. And at the moment, towards the end there, I'm not sure whether you touched much on it, but I think that's the part that Lance touched on it a little bit in terms of where we are at. And we know that there was a budget speech not so long ago that gave us a date of the 1st of September for the two-pot system to start then. And I know we're going to talk a lot about this 1st of September. I think a lot of questions we've been getting as we were leading up to this conversation. Everyone wants to know, when does it start? When does it start? And also, when do we get our money? When do we get our money? Which we'll get to. Let's maybe clarify a bit more when it comes to the 1st of March, as you were alluding to it. So this annuitization, you touched on it. Let's unpack it a little bit, because you said there's a non-vested bit, there's a vested bit, and it all comes together to form the vested pot, which we'll talk about it later in terms of what it is. But let's lay the foundation nicely.
Yes. So, okay. So this is what it is. You're saying pre-March 2021. I've explained that anything that you had before then, you can actually access it fully. Those the rules of the provident funds apply to this amount. And after that, you then got your, even though it was not called two-pot, but you see, as we explained at the beginning, that this was meant to provide financial relief, stress relief at the time in 2020. But the government has been trying, as we said, to have a preservation system in place. And they saw this as an opportunity to introduce a preservation system that's going to force people to to save money to the end. So they took this chance. I mean, if you think about it, 2020 and we're in 2024 now. It's 4 years later, people that were expecting to be given COVID-19 relief never received it, and they kept on being promised about two-pot. It's been two-pot every year until now. It's still being transferred to September, and we don't even know it.
If I may come in there, Pilar,
Yeah.
just to assist you there. You're correct. The government has been trying. I mean, since 2012, 2016, with the reforms, the retirement reforms, the plans to change the whole retirement, regime has always been there, and with the view or the objective of making sure that people, preserve their funds so that they are not dependent on the government. So it's a very funny thing that when COVID came, as much as it came with a lot of challenges, but it essentially assisted and the government into sort of like taking, getting traction from the already existed plans of, providing the retirement reforms. So they saw it as a very good opportunity. In fact, when the DA posed that question of providing relief from, pension funds, the government thought that this was a very good opportunity for them to now steer ahead with their plans of retirement reforms. But even though they were not fully clear as to what is it or how can they actually get there. Remember, getting there means how do you get everybody to be, being able to retire at least in a better off position, rather than not having any savings whatsoever. So in trying to aid that conversation, this 2021 or COVID-19 did steer that particular, or the plans that the government had to finally come to where we are now in respect of the discussions around the two-pot system.
Thanks, Lance. Thanks. Okay, so that covers, the purpose, where it started, and what the government was trying to achieve. So it's very interesting, as you said, Lance. It gave the government a push, a nudge, for them to tie up those plans into a more to implementation, more like. Pilar, please go ahead. I think you were talking about the non-vested benefit.
Okay, sure. So the non-vested part, I think I mentioned that with that, if it's less than the amount that we mentioned, which is 247,500, the post-March amount, you are able to get that as a lump sum. And you will see on the slide here, we've put the two together and call them vested pot. This is going to be important as we go on into the two pot in earnest. This becomes important because that seed capital that we're going to be speaking about actually comes from these amounts as the start that we are going to get. And then after that, obviously, we'll build our savings pot. Rose, without being ahead of myself, I don't know what you have next.
I think you've covered most of what's on this slide, because it was in your explanation. Is there anything you want to add there?
No. Maybe just mention the members over 55. The members over 55 are exempted from the annuitization when it started. Their money continued as provident funds as long as they didn't transfer to other funds. They needed to stay in the same fund throughout, so they are not affected by this. And even in the two-pot system, their system still goes on. If they want to participate, they will participate as an opt-in option. So I think we've covered that. The seeding capital will be taken from the pots that we've explained, and they will only take 10% of that, maximum 30, which will then be used as a start. And after that, every man for himself.
Every man for himself. Okay. All right. So it is called a two-pot system for a reason. There's two pots somewhere. Let's talk about those two pots. Lance, do you want to come in?
Lance is on mute this time.
Oh, your mic is on mute.
No, apologies about that. Yeah,
Okay.
thank you very much, Rose. Again, And Pilar has touched on this, on several occasions. The two pot really, it's saying, how do you make sure that a member goes to a retirement in a way that is decent? They've got funds and that they can have access to, and they cannot be touched. That talks to the one pot. On the other hand, it talks to the savings component. How do you build up a nice savings for yourself, but at the same time, because of the understanding of emergencies that will occur from time to time, how do we create now another pot that you can be able to at least access once in a year? So the two pot really is talking about that. It says, if now I'm contributing 100 rands of my money, a portion of that would go to the savings pot, a portion of that will go to the retirement pot. That's what it is in essence. But what it allows you to do, and this is in a layman's term, it allows you to say the amount of money that goes into the savings pot, I can be able to go and dip into it at least once a year to take care of those January school fees, for example, or to take care of any emergency that can actually occur that may not be expected, but you are still guaranteed your retirement savings as far as the second pot is actually concerned, and that might not leave you into destitution, whereby if it was not the case, or in the previous regime, whereby you would have resigned from work because you wanted to access all your money, and then once you've actually finished all your money. I mean, Rose, if I may come in here, and this is very important. We've seen in our communities how our parents, and in the past, they would actually access monies when they leave some form of employment, go and buy a taxi, buy a van, and do all sorts of things. And ultimately, they are unable to look after themselves because they've actually used up all of their money. So this really two-pot system is actually trying to find that balance. It's trying to find harmonization between you being able to save your money and have a bit of excess of your money annually, and then on the other hand, make sure that you don't touch your retirement money. You continue, to save into that retirement pot. So that is, in essence, all what it is. I don't know if I've actually provided enough context around it.
Yeah, it's a beautiful summary. Thank you so much. Pilar, is there anything you want to add, or is this sufficient?
No, I think that's good. That's yes, thank you.
Okay. So essentially, it means if I were to get into employment, if I were to be employed perhaps for the first time from the 1st of September 2024, and I have a pension fund as a benefit, as an employee benefit, that pension fund is going to contribute, as we see on the screen. There will be a savings pot and a retirement pot. However, there are many people who have been contributing into a pension fund up to this far, and yet at the 1st of September, there are changes. So essentially, those people will end up with 3 pots instead of 2. Can we unpack that a little bit? I think we've already alluded to it because we've talked about vested pot. Pilar did touch on it. Lance has just told us about the 2 pots. Now let's talk about them being in existence as 3 pots for an employee who's been contributing for quite some time. Pilar?
Yeah. So this is when it starts being complicated, that is why you will hear in the industry on a lighter note people talking about are they really 2 pots, 3 pots, 4 pots, or 5 pots? Because I'm looking at 3 pots in front of me, but if you think about it, the vested pot has 2 more pots in there, because we have the other portion on the side that had that we mentioned earlier, which was non-vested 1/3 and non-vested 2/3, which became the retirement portion. So already our pots are more than 2, but they are 2 because what Treasury has tried to do is that on the vested pot, we don't want to bother you. It's yours. It's on the other side. We're mentioning it here so that you don't think we've taken it away. So there are 2 pots because the vested pot is your pot. It's vesting. You can take it using your old rules, your pension provident fund rules, especially in terms of lump sum and stuff like that. So we're not going to touch that pot, except only once. We're going to touch it once because we want to assist you this one time. We're going to take 10% from that pot maximum 30,000. And then we will not touch it again. It becomes your pot. And then on the savings pot, going forward, you will then be the one that's contributing into that pot. You will be contributing 1/3 of your amount every month up until retirement. So as we used an example of 100 rands, if you're contributing 100 rands, 33 rands would always go into the savings pot on a monthly basis, and 67 rand would always go into the retirement pot, which you will never access. It's no go, no touch, nothing. And then at the end of the year, if you decide that you want something, or at your anniversary, because that's what it's called, it's not going to be a year end for everybody, or end of March or end of September. There's going to be some kind of an anniversary that you will know that by this time I can access. Then you can take the amount that you want. And if you don't want to take anything, you can then at a certain time transfer it into the retirement pot. There are other complications that go with that we probably might want to touch on as well later on. Not sure if I've touched everything, Rose.
Yeah, it sounds like it. And I see there's a hand within our guests in the room, but I'd like to emphasize that if you have any questions at the moment, we are taking questions in the chat box. Greg Olivier, I saw your hand there. Please put your question in the chat box. That's where we're taking questions for now. Later on, we will we'll have an open mic session as a Q&A. All right. Pilar, thank you so much. You've really given a nice summary of what it is. So the two-part system really is saying the vested part is all the contributions up until the two-part system starts.
Mm-hmm.
And those contributions will, for a lack of a better word, be preserved and be called a vested part. And because they have been contributed during the time where the Pension Fund Act was what it was, it will still follow those rules, as it were, because when legislation is amended, it doesn't apply in hindsight. It applies from when it starts to apply. So the two-part system starts to apply on the 1st of September, and those rules, those amendments start from the 1st of September. So the vested pot is all the contributions before 1st September, and the rules that apply in the vested pot are the current rules, the old rules, as we may call them. Then the two-pot system, starting on the 1st of September, that's where we're going to then unpack it and talk about what are the differences in terms of access, in terms of taxation, and so forth. And as we unpack, I think my next question, and I think you've touched on some of these things because we have these on the slide, which are points. And I know there's a lot of text on the screen, which is not very PowerPoint friendly, but perhaps you can take us through, Pilar. It just touches on what the rules are now, or rather from the 1st of September going forward.
Yeah.
If I may come in, Rose, and I do apologize, Pilar. I think just before we get into now this level of detail, there's been a lot of noise, and people were asking, what is this noise about the two-pot system? We were once told that it was 1st March, now it's 1st September, now it's going back at this, now it's going back at this. So a lot of people that are workers that I've actually engaged with have asked as to what is this whole halabaloo about the parliament and the NEDLAC discussions, unions, which is obviously COSATU and others. So I thought let's try to understand what has been the noise around the era, if you do allow me, Rose.
Yes, please go ahead.
Okay, so in short or in brief, the understanding, in 2023 has always been that we are all moving now into this two-pot system that we've explained as part of the the retirement law amendment bill, or what is called the money bill. And of course, there's another piece of legislation which is very important to take note of, which is the Pension Funds Act bill. These two bills need to be, amended. In fact, the PFA needs to be amended, and then the retirement law amendment bill needs to be enacted. And the question is that, has that actually happened? That's the first part. The second part is that, what caused the delay for the 1st of March launch of the two-pot systems? Well, just to summarize it, and then maybe Pila can come through and assist you on this one in respect of whether they've been enacted or not. But let's talk to why the move from 1st of March to to the 1st of September. So the minister on the 4th of December at the National Assembly during the Standing Committee on Finance, they accepted a proposal by the Minister of Finance in Okodogwana that the two-pot system must be implemented in 1st of September instead of 1st of March of 2024. So on that 4th of December, during that procession of the SCOFA, the chairperson of the Standing Committee on Finance, Mr. Masonganye, reported that he received this letter from the minister, and he wanted to provide the reasoning why this, this regime needs to be postponed as such. So the first part was that, or the first reasoning out of the 6 that the minister provided, is that the pension funds amendment bill, which was required, for the retirement, law amendment bill to be enacted, has not been tabled in Parliament as yet, and it needed to be approved by the Cabinet for submission to Parliament on the 29th of November 2023, and that will be obviously tabled. So that's the first part. The second part was that the retirement funds will be required to amend their fund rules and submit them to the Financial Sector Conduct Authority for approval. Now, this can only be submitted to the FSCA after the retirement or retirement law amendment bill has been concluded and the PFA or the Pension Funds Act bill have been enacted. So if they have not yet been enacted, the fund rules cannot change. It cannot be sent to the Financial Sector Conduct Authority, as yet, until that has been done. The third reason was that the retirement funds not regulated under the Pension Funds Act, but in terms of this, a separate act of parliament, will have to follow their own processes, and that needed to also be concluded somehow. These, for example, were the government employee pension funds, and of course, to some degree, the Transnet Pension and Provident Fund. They will have to undergo a complex process to amend its rules to accommodate the two-pot in its entirety. The fourth one was that the retirement funds must be able to apply the correct withholding tax rate, and which we've touched on. And the South African Revenue Services, SARS, indicated at that time that it required at least 6 months after the promulgation of this legislation to modify its systems. And if you looked at that November and until up to the 1st of March, there wasn't any 6 months. But also this meant that the industry on its own needed to also ensure that their systems, their processes, would be able to accommodate the changes that will be obviously coming through. The fifth reason was that the implementation date of the 1st of March 2024 would pose significant challenges to the retirement fund asset managers. They will need to ensure that sufficient liquid assets are available to pay the benefit, as well as the bulk withdrawals that will actually happen when that is actually now in effect. Such withdrawals will have marked an effect on the overall South African investment market, and that's what is actually going to happen nonetheless on the 1st of September. And then the last reason was that, as part of the minister's letter, that there should be comprehensive communication and education campaigns by both the private sector, the government sector, the retirement industry sector, to inform members of the impact of the new regime on the retirement fund savings over the long term. So in a brief summary, we're saying that the whole commotion, at least on the surface, has then, in the background, still certain things needed to happen, but they were not ready to happen, and hence the postponement of the 1st of March of 2024 of implementation of the two-pot system to the 1st of September 2024. So I hope that provides the understanding as to what has been the back and forth. I don't know if Pila has got something to add there. Thank you.
Pila.
Yeah, no, sure. Thank you, Lance. Yeah, that's a very good background on all the delays and pulling and pushing. But I know, I mean, taking another angle, I know that COSATU has been not sitting on the side and saying anyone who talks about a delay was not their friend. So they pushed and pushed, even if it was not as favorable as it was. They said their members cannot continue. So as you see it now, starting on 1st of September, if you missed March, they didn't want to allow anything further. I said, no, you must start. So the issue about SARS wanting a further 6 months to implement systems, and maybe the industry, asset managers, administrators wanting more time, COSATU was not going with that. And luckily, they managed to get the SCOFA itself, the parliament, to kind of agree with that. And implementation was then agreed to be the 1st of September. We must be aware that the industry itself is still concerned about the fact that the date of 1st of September has been mentioned, but none of the laws have been implemented, meaning that they cannot really. I mean, I know that some companies might have started working on their systems, but in 2016, systems were changed and the government reversed the decision. So some people are cautiously watching this and saying, let's do maybe half or 80% or 20% of the work in case we're having elections now, 29th of March, of May. Imagine what happens if a new government comes and it's completely somebody else who says, you know what, this was not right. We're not going to do this 1st of September. And you are an administrator and you've changed all your systems preparing for this. So people are cautiously watching this. So we are, as the industry, saying that we are still hoping that something will happen and members will not be disappointed, because all what members want, forget about SARS, forget about administrators, the date is 1 September. I think on the 2nd, members expect to have been paid. Applications will probably come during August or July or somewhere there, 1st of September. Those that deal with clients directly, they will see that they will be asked, "Good, where's my money?" Thank you.
Yeah. And the concern is, are we going to be ready to give out that money? And other things, as Lance has touched on them, because there's, for every action, there's a reaction. So the implications of the changes, they're quite broad, as we've seen on the news as well. All right, so let's go back, and it's a great introduction. It gives a bit of context as to what has been happening and why it has delayed so long. And it also opens our minds to look at things to follow, because it sounds like there's a lot that's still going to follow leading up to September, and also prepares us in terms of what to expect. Do we expect to withdraw on the 2nd? Are we really going to get our monies on the 2nd of September? The question is out there. So let's go back and talk the details that we wanted to get to in terms of what the savings pot looks like, and in terms of also how it's going to start. This 10% kept at 30%, at 30,000 rands from 1st September and so forth. Let's unpack that a little further and get into the rules a little more. I'm not sure what's happening with my cursor. Just sorry, bear with me. However, Pilar, perhaps you can continue while I'm trying to solve my. Okay, there we go.
Okay, is this where we are?
This is where we are. Yes.
So you see, this is the slide that if you have a camera, phone, whatever, you can take a picture of the slide, because it puts all the detail that you need to understand about the two-port system as it is going to be from the 1st of September. Your vested port, we've put a lot of detail on that. We said it's what you had. You can call it legacy fund of yours. The savings pot is going to start now, starting with the 30,000 maximum seed capital, which will be taken from your vested pot, which is 10% of that, maximum 30,000. And then you will have thereafter 1/3 of your contributions will be going into this savings pot. The minimum withdrawal will be 2,000 rands. If you've got less than that, it's not your good year. And I suspect you could have just started working and you've not made enough contributions, depending on your earnings. There will be withdrawal costs that will apply. people will be paying for this. The administrators will be doing a lot of work preparing this and applying for tax and stuff like that. There will be money that will be paid to the administrators, so you must be prepared. That is why you can't just take any amount. And then there's a marginal tax rate, which is very important, that you need to be aware that I mentioned earlier that you will be taxed at a rate of 27,500. I mean, not a rate, rather your first 27,500 will be tax-free on your withdrawal, and at retirement it's the first 550 is tax-free. When we do this two pot, you will be taxed as if this money is going into your own salary. So if you take 10,000 rands in a particular year, that 10,000 rands will be treated as if you've received an additional 10,000 in your salary, and it will be taxed at your marginal rate. Marginal rate are your normal tax, individual tax rates, which are higher than your retirement tax rate. So that will affect you over time, that you keep on going into that amount. You see, while I said the government is trying to incentivize us to save, they're still hoping that we don't use this savings pot. Because on that savings pot, you're not taxed in terms of the favorable retirement tax rate. You are taxed as if government, why are you taking this money? So you're taxed at a marginal rate. It's not a good rate for you. And this amount, if you don't really want to take it every year, you don't take it, because there will be such people. Because remember, funds have even options for members to make additional voluntary contributions. So there are such members who are making additional voluntary contributions, and this could be an irritation to them. That why are you creating a savings pot for me to access when I'm actually trying to build because I started late, or because something happened and I don't have as much as I want, or my net replacement ratio does not look so good. So I actually don't want to access this amount. So on an annual basis, these members will be transferring this money into the retirement pot, because there they know no matter what happens, they will not be able to access it. There are people that will be opting for that. And this growth can be taken as cash at retirement, or if you leave before retirement. So because the retirement pot, it's been cleared that is, you cannot touch it for whatever reason. You will touch it if you retire or at death. Even the retrenchment, we're going to talk about that, has not been allowed to go into that pot. Retrenchment will not be treated as your full access to retirement pot. So that means that if you have taken something already from your savings pot, and at the end you reach retirement, if that amount is less than 2,000, you will be able to take it. But if it's more than 2,000, you will be you will have to transfer it into your retirement pot, which is now it would form part of your annuity, part of your pension into the future. So I hope I've managed to simplify that, Rose. Thank you.
Yes, and I want us to
okay, I didn't go into the retirement pot. Okay.
Can you pause a little bit? And I just want to ask a few questions regarding the savings pot in particular. Okay. And these are questions that our clients have been asking, and I'm just going to get into that because I think it's going to benefit a lot of our audience members. Now, that seed capital that's going to come through, capped at 30,000. I want us to be clear about it, because it says 10%. It says 30,000. Can we unpack it a little bit so that we have a good context? What should we expect? How much money is going to be there? And that seed capital is what you said from the 1st of September, just as a once-off. There's money that's going to be taken from the vested pot. If you have contributions that you've been making so far, as a seed capital, to say this is your start, this is a starting money that you can access from your savings right at the beginning of the two-pot system, 1st of September. 10% will be taken from your fund credit that's available, that's already in your fund that you've contributed. Capped at 30,000. Just let's make it clear in case there's a bit of confusion there.
Yeah, thank you very much, Rose. I think that is a very important and interesting question, in that I think a lot of people out there they heard about this 30,000 and it was 25,000 before, now it's 30. They're thinking in their mind that there's going to be 30,000 for all of us at the beginning of September 2024. But that money is your money. It's being taken from your money. If you have it, you will get that maximum exposure to that. But remember, there's still going to be tax. But at least let's talk the amount itself. So if you've got it in your vested pot, it will be brought in, that maximum, to 30,000. But if you don't have it, somebody has just started, they've been contributing into a new fund just now. So they don't have that kind of money. So it won't be there. It will be less than 30,000, if anything, or it will be a very low amount to an extent that someone cannot even access it if it's less than 2,000, because you need to get at least a minimum of 2,000. So that is the story with that amount. It's taken from your previous funds and it's once off as a start, and after that you will build it up yourself, and then you can know exactly on a monthly basis how much you're building up.
So if I may, okay, let me make a few examples. If in my fund I have 100,000, that means my seed capital will be 10,000. If I have 1,000,000 in my as my fund credit, I can only get 30,000 because that's the maximum.
Yeah. Even though your 10% is 300,000, you'll only be getting up to 30,000. Yeah.
Okay. All right. I hope that is clear enough. So you also mentioned that in terms of withdrawals, as you said, minimum withdrawal is 2,000. So one cannot withdraw less than 2,000. It has to be more than 2,000. And there will be withdrawal costs as well as tax. And the money that we are withdrawing from the savings pot will be considered as part of our income, taxable income. So it will be included in our taxable income. And generally speaking, because we are talking about an employed population, it then talks to their salaries directly. Yes. So your annual salary, your annual taxable salary, as you made an example of, if I were to withdraw 10,000 rands, that will be added into my taxable income. So there are some people that may move from the tax table, from their tax bracket, maybe to another bracket, if that 10,000 really moves them to another tax bracket. But they will see some variations, possibly from their tax deducted tax at that time, at the year when this happened. I think that covers a lot about the savings pot. Lance, do you have anything to add?
I think, Pilar has provided a very comprehensive understanding in respect of the savings pot, the vested pot, and so forth. And of course, the issue around the seed capital. And, you with your follow-up questions around the actual amounts. If you had 100,000, therefore, what does that mean? What does the 10% represent? If you have 1,000,000, what does that represent? So I think we all covered, and I would spoil it if I were to add anything else. Thank you.
All right, thanks. Let's talk about the retirement pot.
So we said the retirement pot, 2/3 of your contributions on a monthly basis will go towards this pot, and it can only be accessed at retirement. Permanent disability, it will be monthly income, and I think that and then at death only. Really, it's retirement and death, and it can be transferred across funds. You can transfer from one retirement pot in one fund into another fund. And if you resign, withdraw before retirement, this pot will remain as a deferred benefit in the fund until retirement, fully inaccessible. The full benefit must be used to buy an annuity at retirement. You see, we're talking only about the retirement pot, so the full benefit will be used. But if this pot plus your non-vested pot, which was at the top when we started, that non-vested portion, when we're talking vested pot and non-vested pot, that vested pot portion, they both are less than 165,000. Just the 2/3 is less than the 165,000. You can withdraw the full amount. If it's more, you then have to start purchasing an annuity and getting a 1/3 of it as a lump sum.
Okay, I think that sounds like it covers it. I don't even have further questions except um, uh, maybe let me give Lance a chance if there's anything to add, because my questions will then expand the conversation further to say, all right, so we've covered access, we've covered a lot when it comes to the savings part. We even touched on tax. What are the tax implications of the retirement pot? And what types of, we talked earlier on about different types of pension funds and that's available. What type of pension funds are affected by these changes? Is the two-pot, for instance, applicable on a retirement annuity as an example? Those are my following questions, but perhaps if I can do a quick check with Lance, if there's anything you want to add in relation to the retirement pot.
Yes, thank you very much, Rose. I think one aspect that we can just summarize as well is the issue around the types of deductions that would obviously be provisioned as part of the Section 37 of the Pension Funds Act. What type of deductions? While we've spoken about the income tax will be a deduction, the pension-backed home loan will still be applicable, the maintenance orders will still be applicable, divorce orders will be applicable, and of course, employer damages via court orders. And these will obviously be affected against your vested pot. So these are very important for us to understand that they'll still form part and parcel of the variable deductions that will be available on the vested pot only, and of course the retirement pot. I don't know if that adds up to the totality of our discussion. Those type of deductions are very key.
Yes, they are, and thanks for adding that. And perhaps we can get into my questions as I've mentioned them. And I have an additional question. Now that we have two parts, when it comes to growth, are they going to grow equally? Because pension funds are meant to grow. There needs to be some investment type of activity in terms of growing compound effect, it should be a compounding type of a growth. When it becomes a two-part system, how will growth look like? Then if you can touch on also the tax part of the retirement pot pillar.
Okay. Yeah, very important question about growth, because that relates to the investment strategy of various funds. If you look at the savings pot on a lot of fund, if I use a loose word, they are going to be rated. People are going to be withdrawing at different dates, different days. Administrators are going to be working with withdrawals almost every day. So that talks to liquidity of the investment strategy, the liquidity of the fund, in that the fund should have money available all the time. So managers are likely to use strategies that allow monies to be easily available. So that is not monies that can be invested in a long-term investment or aggressive investment. So we are likely to see very either balanced or even conservative investment strategies applying to savings pots. And now that becomes a problem immediately, because we mentioned earlier that there could be people that will be saying, why bring this to me? I don't need this because I want my money to grow. I'm actually even contributing additional voluntary, I'm making additional voluntary contributions. I don't want this. It's a nuisance for me. But that money will be sitting there because the law says 1/3 of your contributions will go effective 1st of September into a savings pot, 2/3 will go to retirement pot. So the government is telling you what's going to happen. But then, because they know that you might not want that irritation, they say you can transfer the money from your savings pot into your retirement pot. So what we anticipate is that the savings pot is likely to have a very conservative investment strategy because it needs liquidity. But we also expect that the retirement pot, because that one they say don't touch it, it's going nowhere. So they are likely to get more aggressive with confidence, knowing that no one is going to bother us here. I'm talking investment managers now. No one is going to bother us here because the government has said no one can access this money. So the access will be your normal death benefits, withdrawals, and which they are used to, and just retirement. But otherwise, it won't be rated as much as your savings pot. So the strategies might have to be different to consider that. Thank you.
While we're still on the growth point and we haven't touched on the tax and other things. There is a question in the chat box that says any tax implications later on accessing these funds. But the part of the question that I'd like us to cover now is it advisable to access these funds? Maximum 30,000 on an annual basis might have negative effects of some sorts. Do they? Is it a good idea to raid, as Lance has put it, to raid the savings pot and use those funds, especially given what you've just said about the conservative nature of its growth?
Let me come in there just before you, Lance, to explain also just the raiding part of it. This is a strategy to allow people emergency funds. But I'm talking from a practical point of view. Ordinary workers have been wanting emergency funds available to them all the time. So a lot of people are likely to actually be going to the fund on an annual basis, because you won't go quarterly, you'll go only once. So people will be building that. Some people will be building that with the view that at a certain date I'm gonna access it. But it's not what it's necessarily intended for. It's supposed to be used for emergency fund. Even anyone who thinks, okay, if you think you don't need it, you don't need to go there. You can take it that year and transfer it to your retirement pot, because there you know that you're building towards your retirement. And the 30,000, we will have to forget after 1st of September 2024. We will have to forget about the 30. The 30 is once off. After that, your 1/3 will determine what is the amount that you can access at the end of the year, or at your anniversary that you're allowed to withdraw by.
And while you're saying that, let's put that into context a little bit, because as you're saying, 30,000 is the maximum. We've already unpacked that. It could be less for other people because it's actually 10% of your fund credit at the beginning, which is 1st September. And then once that once-off capital seeding contribution has been made, the savings pot will only take 1/3 of your monthly contributions. And bearing in mind that from your salary, you're contributing a small portion of your salary into a pension fund, which, yes, your employer will also contribute. And it's not quite a big amount for most people. Of course, it's salary dependent. If your salary is a lot, then maybe it's a lot, because 10% or 7% is 7% of what, right? So if it's a big amount, yes, perhaps the contributions will be sizable. For most people, especially blue-collar workers, that is a very small amount. So on an annual basis, for most employees, they won't build up anything even close to 30,000.
Correct.
In terms of it also being 1/3 of those contributions.
Correct. I mean, yeah. if I come in quickly, like your example, let me take 10,000 rands. Let me take 10,000 rands as just an example. Let's say you're earning 10,000 rands. After tax, you have 10,000 rand, whatever the amount is. If you say you're contributing 10% of that, and both you and employer are in that 10%, that's 700. That's how much is that? So, I mean, let me say 7%. That's 700 rands. 700 rands. If I say 33% of that, let's say maybe I'm gonna use. I don't have my calculator with me. Let's say it's 300 rands a month goes into savings, and the 400 goes into retirement pot. Do you understand that the 300 times 12, it's 36? That's 3,600. It's nothing close. And we can double that and make it 20,000. Make it you're earning 20,000 a month, and make that amount 600. 6 times 12 is how much? It's 5,000. So basically, it is that 30,000 was an amount that was probably well calculated, and they looked at the earnings and whatever. So it's not going to be like that. It's going to, like I said, when I said every man for himself. After this 30,000, after that, everybody. And also, let me just mention one point, because I mean, Rose, this discussion on two pot can take the whole day. That's why we don't mention certain points. It's not because we don't want to touch them, but we don't have time. But if we make an example, the fact that you're going to be charged taxed at your marginal rate, let's say you get the 30,000, they say you've got 30,000. But if you're earning the highest, earning 55% tax, you can just get my calculator. If you're earning 55, your tax rate, you've fallen, you're earning over 1.5 million. I'm going to use that because it's easier. Over 1.5 million, so your tax rate is at maximum, which is at 55%. The 30,000 at 50, you're gonna get only 45% of it. So it's 30,000, 45. 45% of that, it's much less than 30,000 that you're hoping for. You're taking more than half. It's 13,500 is what you have, because more than half of that amount, which is 15,000, is going to tax. Another 5% is going to tax. So you're only 13.5. So the tax, that marginal tax rate, is put there for a reason, to discourage this. So a lot of people that are high earners and not needing this are not going to do it, because they're going to see that I'm actually taking myself so much back with my contributions, but yet giving so much to the government. But I'm not going anywhere except going backwards. So that is a fact we need to be aware of.
And yet the reality is that we're actually taking money, we're almost taking from our future. Because this money is meant to take care of me when I get into pension, when I get into retirement. And now I'm actually eating from my savings, my retirement savings. That's what it is.
Yeah. I wanted to add, Rose, that in honest and honesty, people who earn higher salaries, it would be highly irrational for them to go in deep in this pot, because they'll definitely be walking backward. So as much as this is being introduced and people are all excited, but if you think about it, it starts not making any sense for you to go and give so much money back to the government. If you gonna be taking 2,000-3,000 rands, provided that you have it, and then it's a different story altogether. 10, 15, those kind of amounts, it will obviously make sense, provided that there's a serious emergency. But anything above that, it's that you're starting to give away money to the taxman. And it still impacts you when you go on retirement, because that money would have been, been a good buffer for you to be able to retire comfortably.
Yeah, so that's why I think it makes sense then for it to be called an emergency fund, because you use it when you have no other place to go to get money, and that's what is the system is trying to encourage. Hence, we are bringing the education so that it's clear. This is not just a dip in the fund and anything goes. There are implications, and most of them are negative. I'm looking at the time. We've done so much. We've actually covered so much ground, and yet I don't want to leave this forum without giving enough time for us to take questions from the audience. And yet we haven't even covered everything. But I think what we've covered is sufficient. So would you allow me, and I'm asking you as my guest speakers, to open the floor for questions? Is there anything you want to add before we get there? There's a lot, I know, but can we just get to it?
I think I mentioned that two pods can take the whole day.
Yeah.
The issues, the matters that are not mentioned here, it's not because of lack of a skill. It's because we really can't cover everything. And I'm even listening to you nicely saying this pot should have been called an emergency pot, because our understanding of a savings pot is you go to a savings pot now and then. Emergency, it's for emergencies. So people are going to say, I've got a savings. Don't worry. A certain date, 15th of March, I can access my savings. So that's how it's going to be accessed by many, because it's there and it's available. But I'm quite happy and keen to hear what our audience have got to say. Maybe they can also tell us something that we might have missed if we've covered what so far. Yeah.
And I know, and I'm just actually noting that I did say I'm going to ask about tax when it comes to retirement pot, as well as the types. Can you just quickly touch on that, Pilar, for a minute or two, really, just so that we give justice to that question?
The retirement pot, the taxation will be the one tax table, which is the retirement fund tax table. The one that the first 550,000 is tax-free, and the rest is according to that table. So the other table we spoke about, you can forget about and just think about that one.
Okay. And the types
The types
of retirement savings, we spoke of different types: RA, Provident Fund, Pension Fund, Preservation Fund.
or how they fit into two-pot.
Are they all affected? Are there any exclusions?
The pension and provident fund, we've spoken about the history. The retirement annuities, there was a statement issued that there's what is called legacy retirement annuity funds will be excluded, and there was a date set up 20 something going back. Those will not participate in two-pot, but from a certain date going forward, those will be considered for participation. A preservation part, a fund, it doesn't get into two-pot because, as we said, it is you're carrying a bag and you put it somewhere and then you move on and then you come back and pick it up. So that one is not a two-pot. It's a two-pot if you want, because you can go, if you've not taken your first withdrawal, you can just take all of it or a portion of it and then the rest when you retire. So that is not part of this.
Okay. And I hope all the questions in the chat box have been covered. I really tried to do that. I think I have covered them. And now, if there's anyone who'd like to ask questions, please raise your hand so that we can take those questions. And I'll open the mic for you to then contribute with your questions. As I'm waiting for questions, what have we not covered? I think this is a very interesting question.
So if you want us to go there, I mean, just to show you the extent of what we've not covered, Lance mentioned the issues that Lance was mentioning, the deductions. Those we've not covered. He's just mentioned them because they've got also their peculiarities. They've got their detail that we need to go to. The divorce orders, the pension-backed home loans, maintenance orders, Section 37D, other deductions. What happens if your seed capital is not enough? We need to talk about those in details. Retrenchments, the bracket creep you mentioned today, we need to go into some detail. Investment strategies by different funds. Can you opt out of the system? Can you say, I don't want to get into the system? We've not discussed that. Long-term effects, there's a study that was done in Chile and Peru, where it was found that actually when this was open, and it was open during COVID, correctly so. During COVID, Chile and Peru opened up and said, you can get one withdrawal here, one withdrawal there. And this study is from Old Mutual. And it was found that they actually, members maxed their benefits. It didn't go well. In some instances, up to 70% of the benefits were taken out. So South Africa is probably studying that to see how they can control us further. And just the fact that we still have rule amendments that need to be done. It won't happen the same days. SARS preparedness. SARS has said we will only be prepared probably 6 months after. And I want us to say this now so that our audience can know that if people start saying, but now why is it not happening immediately? They will say, nah, the guys did mention to us that it won't be like that. SARS is going to wait for the law, like Lance mentioned, to take effect. Once it is in effect, then they will start the work. They are not starting the work before. And for those members that really they need to contribute further, what does this two-pot mean for them? The members that need additional voluntary contributions, are they excited about this, or are they saying this is just an irritation? It's defocusing us, Yeah, so those are the kind of issues that in our next sessions we might want to
the
look
issue
into.
of retrenchment pillar also.
Yes.
Well, how do you treat retrenchment? How is this going to actually impact on you? But Rose, I think there was a hand from Greg Oliver. I think he needs to be given.
Yes, I want to give Greg Oliver a chance. And there's also a question I missed, which was saying, is there a waiting period? We can take that after Greg has come in. Greg, I'm allowing your mic. Please do ask your question. You can unmute. Greg, you're still on mute. Are you able to unmute your mic? I've allowed your mic. Okay, your mic is able to, Greg, but yes, I can hear you. William, you are
All right.
noted. I'll unmute your mic when Greg has asked his question. Go ahead, Greg.
All right. I'm 61 at the moment, and I've been working for this company. By the time my retirement age comes, which is in 4 years' time, I'll be there for 18 years. But in the interim, I have worked for a lot of other companies, and every time I've resigned or left the companies, I have taken my pension fund out and I've invested it somewhere else, and then I've bought property. So now at the moment, the property that I own is fully paid for. I don't own a cent in it, but I've added extra money into my pension fund because it's not going to be that much when I retire. Was that a good idea or was that a bad idea?
Well, it's a good question. I can tell you that, Greg. Let's hear from Pila.
Yeah, you see, Greg, very interesting question. Let me put it out there that I'm a qualified financial planner with the Institute of Financial Planners, but I'm not practicing as such. I'm practicing as an employee benefit. So I work mostly with group benefits. But you know, our intention for all of us is to look for what we call net replacement ratio. We're looking for what is going to support us when we have stopped working. And for me, as I was growing in the industry, my net replacement ratio was not always skewed towards insurance, as you call it, or industry, the retirement funds industry, was when the people of Provident Funds got that lump sum, some of them used it wisely and they were able to sustain themselves for life. That is still an annuity. That is still a pension. Doesn't have to come from an insurance company to be an annuity. So if somebody wisely bought a shop, a butchery, or invested in a store, or did this and this, that is also part of your investment. So for I think it's Greg, for Greg to have used some of his money for property and to invest in a property and make sure that it either gives income or it's an investment that is sitting there growing in case at retirement you are able to sell it off and have your own annuities going forward. That is also part of an investment. In terms of speaking to Greg on all the investments or how he has built up, we need to do what is called a needs analysis of an individual. That needs to sitting down. So I think on a very global situation is that investments are, as long as you're looking at when I stop working, will I have income supporting me? If the income is there, then your investments have been quite smart into the future.
Numbers
Thanks.
don't lie.
No,
They will tell us.
Yeah, that's what you see. My thought of thinking is when you retire one day, nobody wants to have a bond over their head that you have to pay out every month because it depends how much money you get from your pension and how much money you've worked for a company or how long you've worked for a company and what your pension is worth. And that's why I built this place and it's paid off cash and this is my retirement home. So all I want to
Yes.
pay is a small amount out every month.
Yes.
And that's the
Yeah.
best way I thought of going. And when people say to me, I should never have taken out my pension fund from other companies that I worked for, I should have rather just transferred it over. And I said, no, I've got a plan of action that I want to buy property and invest in property and sell and make money and buy and sell and make money until I've got enough money to pay this house cash, which I've done.
Yes. I mean that requires, Rose, just one more minute. That what you've done, Greg, is what is discipline in investments, because somebody else would have taken the money and tried to start something but then use up that money. Then your friends were right to say you should not have taken it out. But if you've taken it out and diligently invested it, then you have created what you require for your retirement. Because when we talk about net replacement ratio, we are assuming, as you've said correctly, that you have now settled all your debts. You are now looking at how much do I need now to live going forward? And that is the path that I think you have followed. And you should be still in the right path, but you are managing your investment yourself, not someone doing it for you. Thank you.
All right. Beautiful question, Greg. Thank you so much.
Thank you very much.
Thanks, Greg. All right, so let's give William his chance in the spotlight. William, you can unmute your mic. William, you need to unmute your mic so that we can hear you. And we are running over, and apologies for that. We'll just take a few questions as we are closing the session. As we're waiting for William to unmute his mic, there is also a question in the Q&A, in the chat, sorry, that is asking, earlier on we said withdrawals are going to be considered as part of the 550,000 on retirement. So in the two-pot system, as we are withdrawing from the savings pot, is the same going to apply or is it different? Your mic is on mute, Pilar. Are you able to unmute it?
Sorry, Rose, I changed my screen to
Okay.
see something else, and now an old man, so I couldn't find it.
All right.
All right. So we mentioned that your from your savings pot, you will be taxed at your marginal rate. That's why it's going to be added into your monthly income. So you've paid your debts. Taxman won't come back. It's going to be taxing you as you take it every year. And if whilst you are building your retirement pot, then your retirement pot will only be considered for this. So otherwise, the taxman will be double dipping if they were to consider your pot. The only thing that will be considered on the pot is if there is a small amount that is left, or those amount that you were transferring into the retirement pot, you will get the benefit of those amount from the savings pot into the retirement pot, a benefit of being taxed at retirement rates because you never use them when they're in the savings pot. So you didn't get the marginal taxation on that side. So yeah, there'll be no double dipping by the taxman. At least that's what we know.
Yeah, because the retirement rates are quite favorable compared to any other table we have talked about so far. Let me check on William again. William, at any point when you are able to unmute your mic, please go ahead so that we can hear your question. Otherwise, I'm going to consider the question that I said I've missed earlier on, which was asking if there's any waiting period at all. And Greg, I think that is your legacy hand, if you can lower it, because it says to me there are questions and there's none. Otherwise, there was a question on the chat that I missed. Let me just go back to it quickly. Yeah, it's asking about a waiting period. Is there any waiting period? And I'm assuming it's saying, I'm not sure when it says applying, but I think because we're starting, the start date is the 1st of September. Are we just going to hit the ground running, or is there going to be any waiting for something to happen before we can? We've already said on the 2nd, people will be expecting to be withdrawing. Is that going to happen that way, or will there be a process? What should we expect? Hila, do you want to come into this one?
Okay. No, the waiting period will be a technical and a practical one, in that you need someone to pay you that money. If that individual is not ready to pay you because their systems are not ready, or if SARS is not able to pay you or approve your payment because their systems have not been are not ready for that, then you will not get it immediately. So the waiting period in terms of the government's intention is not there, in that they're saying from 1 September people should be paid, but they know from a practical point of view that they've not even accepted the law in parliament yet. They've not accepted rule amendments in terms of the FSCA. They've not approved any, because they also can't approve any rule amendment because they don't have the law in place yet. So there isn't, as we know it, any waiting period. But I suspect what could happen is that various funds, because they belong to various administrators, you could get those from different funds to say, your fund will have this waiting period because our administrator can only be ready at this time. but knowing that you are all entitled to withdraw from the 1st of September, but practically it's not possible. And after that, maybe somebody is saying, after that, after I've withdrawn, now I've withdrawn, I've waited and then now I've withdrawn. How long do I wait again? What is my other waiting period? We suspect that there will be anniversaries that you can only withdraw at this date for everyone, so that people don't, every time they've got over 2,000 rand, they come back and say, can I get that 1,000 rand? I'm in trouble, I need money. They will be given anniversary dates so that they withdraw at that time. So the waiting will be, you have to have sufficient funds or you wait for your date that is applicable to you. Thank you.
Thank you. And we have been waiting for William on the subject of waiting, and it seems perhaps he has technical issues, but his mic is I've made it possible for him to unmute his mic. Due to time, it's 8:10. I suggest that we wrap up. And as we wrap up, I'd like also the audience to interact with us and let us know on any of our platforms. We have our details that we're going to share now, and also we will be sharing the slides with everyone, because when on registration we got your email addresses, so we'll be sending you the slides so that you can go through them. There's more information that we haven't covered, but we've covered verbally. We haven't covered on the screen, just to give you a summary of what we have covered today. And so we'd like to hear from you if there's more that you would like to know about the two-pot system, so that we can cover the areas that we haven't covered. And we are planning on having these webinars on the regular, at least once a month. So we'll be in touch and we'll let you know on the next topic on our webinar. Our financial wellness scope is quite wide, as I've mentioned at the beginning, in terms of the work that we do as Financial Journey. It touches on quite a number of personal finance topics. So let me give a minute, 30 seconds each for closing remarks from our guest speakers. Can I start with you, Lance?
No, absolutely, Rose. I think the understanding here, and and Pila has mentioned this, that the enactment has not actually happened. So it's everybody's guess as to what's going to happen. We don't know.
Can I interrupt you? And it's because I'm excited that William has finally got his mic to work. Please hold that thought, Lance. Sorry to interrupt you. William, please go ahead.
Good evening, guys. No, I just wanted to check if maybe I missed something. Man. Are you guys saying that the two-pot system started 2021 February? Because the information we got was that it started last at the end of March.
I think Lance can continue there.
Oh, yes.
Yeah, and I think, William, you missed maybe the beginning of the discussion, because that was covered, but we can summarize it in response to you. And I have to emphasize also, we will share the recording of this webinar. I think I actually neglected to say at the beginning that it is recorded. Apologies for that. However, we will share it so that what have been missed by those who joined later, they can go back and consume it and watch it. Lance, go ahead.
Yeah, no, thank you very much. Just to briefly answer William, is that William, the two-pot system has not yet started. We are busy in the process, or the government is busy in the process of ensuring that it starts on the 1st of September 2024. That's the most important date. But over and above that, you'll get information as per Rose that would take you through what would actually happen in terms of the timelines. But if you want to maybe further ask more questions, you're more than welcome to get in touch outside, of course, of this platform. In my closing remarks, I wanted to say that I think the education of our people is very important. I'm not too sure what the government is going to be doing to ensure that the promotion of education financial literacy around the two-pot system is actually prioritized, because this will bring about certain, elements into it that may obviously, even though the intentions were good, but the consequences may not actually be the ones that have been expected. So financial education, financial literacy, and it cuts across all the sectors of our, of our society. It doesn't have to be people who are frontline workers or people who are in senior management and so forth. It cuts across. So there needs to be some kind of a drive, an educational drive, to empower people as far as this area of interest is concerned around the two-pot system, or three-pot system, or five-pot system, as it were. So the conclusion is, we hope that the educational aspect of it are not neglected, but they are actually prioritized as part of this process. Thank you.
Thank you so much, Lance. And Pilar, closing remarks?
Yeah, thank you very much. I think for me, the no one can really claim to know enough or everything about two-pot. We get confusing questions all the time. I mean, the government has also changed so many things themselves. There was a presentation by Treasury yesterday where they were clarifying certain things and acknowledging certain confusions they've created, and changing certain things they thought would work. They know they won't work now. So we encourage people to keep asking the questions, because it really does not give us a final confidence as we're going along, until the date comes and until it's in Parliament and everything. The interesting thing about two-pot is that it's for everyone, whether you're an executive or a junior employee or blue-collar worker. It applies to everyone, and people have the same questions, because we are not in the industry all the time. So the confusion is always there, whether this thing will give you anything. I mean, I got a question a couple of weeks, months ago, from someone quite high in an executive position, saying, when is this thing coming up? And I said, no, on this date. He said, but guy. When I mentioned the issues of 30,000 minimum, max and 10%, he was put off immediately. So do not think that when you still have questions, if people elsewhere understand it better. We don't understand it better. We are all learning, and we'll continue with these education forums so that everybody can understand. Thank you.
Thank you so much to you, Pilar, and both of you really for the time, and everyone on the call. Thank you for joining us. We really appreciate you taking the time in the evening. And by so saying, I would rather just end the conversation by emphasizing that we're talking about retirement savings and retirement investment. Really, that's what it should be, because saving doesn't relate to growth. So it's putting money away so that it grows enough to take care of you on retirement. And as we've touched on a number of things, yes, pension fund, pension and provident fund are offered. We don't have choices there. They are offered as a benefit at employment. So we don't have to choose in the products. Some of us don't even know where the funds are invested. Of course, if you do a search, companies like Alexander Forbes will give you the information to say, here is where your fund is investing. And also there are trustees that are appointed in your companies that are taking care of those interests. So a company can, or members of a pension fund, are able to say, we don't want this fund to contribute, or rather to invest in such and such company. There's those allowable rules in pension fund. However, that being said, there are specialists and experts that are able to give counsel, to give advice, even for the trustees who are appointed, or you as an individual, if you would like to invest further. So please get in touch with the right people who are registered. Pilar has said he is a certified financial planner. A financial planner will be able to help you to get your own personal saving product that is suitable, that meets your requirements as a person, because there's also different circumstances that people have. So in our team as Financial Journey, we do have certified financial planners who can assist with that. Get in touch with us. We do have our website, which is financialjourney.co.za. Look into that so that you can find our contact details, or you can send me an email at rose@financialjourney.co.za if you have any questions that you would like me to cover specifically, or I can get you in touch with an expert who can assist you further. Thank you again. I see a lot of people are already signing out. Let us do the same and call it a night. Adios. Have a good evening. Till next time.
Thank you.
Cheers.
Thank you very much. Cheers. Bye-bye.
Bye.